Good afternoon and welcome. Thank you for joining us today, where we'll be looking at how to drive returns through innovative EIS and VCT investing. I'm Wayne Readshaw, BDM at Blackfinch, and I'll be host for today's webinar. During the next hour, you'll get to hear from Dr. Reuben Wilcock, Head of Ventures at Blackfinch. Plus, you'll also get to meet the founders of two of our fantastic portfolio companies. Now, you're currently on listen-only mode, but if you do have any questions, please can you send them to us via the Zoom Q&A function at the bottom of the screen, rather than the chat box. Time permitting, we'll answer as many questions as we can at the end. Now, just some important information before we start. Blackfinch is regulated by the Financial Conduct Authority. Everything we're going to share with you today is designed to be informative, but it doesn't constitute advice, of course, be that financial, legal, or tax advice. Now, an additional slide here on the important information. Now, this is something that's changed recently with the regulator. They now require risk warnings to be shown on all EIS and IHT investments due to the potential for losses. It's important that you do get used to seeing this information, and it's really because these products are different from mainstream investments such as ISAs and pensions. As for today's learning objectives, at the end of the session, you should be able to describe the stages in the life cycle of a successful early stage tech company, to explain how risk in venture capital investments can be mitigated through portfolio diversification, and also articulate the steps by which high growth early stage companies are filtered by venture capital firms. Now, I appreciate that some of you listening might not be so familiar with Blackfinch, so I'll cover our group structure very briefly. So the ventures business that we'll be focusing on today provides funding for early stage startup and scale up companies in the tech space. Reuben will obviously tell you more shortly. Now, investors can access these companies via our Ventures EIS and Spring VCT. Blackfinch Investments also offers business relief qualifying IHT services for both private and corporate clients. Our asset management division provides risk-rated multi-asset funds and discretionary managed portfolios. And at the bottom, Blackfinch Energy owns and operates renewable energy, UK-based wind and solar assets. The property business provides lending for borrowers such as residential and commercial property developers. So those energy and lending trades are investment sectors via our Adapt IHT portfolios. Now, for those of you that are less familiar with EIS and VCT investments, I thought I'd just mention some situations in which we see advisors using them within their clients' financial plans. So aside from income tax relief, EIS investments can offer CGT deferral. So if you've got clients who have perhaps realized gains on the sale of investment properties or other unwrapped investments, they can defer the gains via EIS. Now, this is likely to be more attractive in view of the imminent reduction in the CGT annual exemption. Now, many advisors are using EIS investments, or at least looking to, where their clients can benefit from at least two of the main tax reliefs. So income tax relief, capital gains deferral, or income tax relief and inheritance tax relief. And don't forget that EIS does allow for higher investment levels to be made over and above VCTs. And you can also carry back to the previous tax year in order to claim income tax relief in that year too. Now, as Reuben will explain, VCTs usually invest in slightly later stage businesses. They can offer simpler admin due to investors owning shares in listed VCT rather than directly in the underlying portfolio companies. This can also enable much quicker tax and share certificates to be issued rather than the EIS. Business owners could use VCTs or EIS to offset dividend tax when extracting profits. And we see many investors who are funding for retirement and either want to invest more than the pension annual allowance of 40,000, or perhaps they're high earners who are subject to a tapered annual allowance. Likewise, those that are near or have reached their lifetime pension savings allowance they can also fund VCTs and build a complementary pot of high growth investments, which can also pay tax-free dividends, of course. And we're now seeing an increasing number of investors who are using VCTs annually. And perhaps once they've made their first investment and it's been held for 5 years, their year 6 investment can effectively be made by reinvesting that year 1 capital. Year 7 comes from year 2 and so on. And this really does allow for that ongoing plan with only a 5-year capital commitment for the client. So they can still benefit from income tax relief on those year 6 investments onwards. Now, I mentioned a few additional areas of support and resource at the end, but for now, I'm delighted to hand you over to Dr. Reuben Wilcock, Head of Ventures at Blackfinch. Reuben.
Hi, Wayne. Great to be on the event today. Really good to meet you all virtually. Thanks for the intro there, Wayne. So yeah, I head up Ventures at Blackfinch, and what I'm going to do today is I'm going to talk you through 4 key areas. I'm going to talk to you about the team. I'm going to talk to you about the products, the process, and then normally I would talk to you about the companies that we've invested in, but we're really lucky today because we've got 2 of our founders from the portfolio here who we'll be talking to as well. So that should be really interesting towards the end. But let's start with the team. So we're quite unusual at Blackfinch because in the Ventures team, we are nearly all ex-founders, ex-operators. We've started companies, we've built companies, operated those companies, and some of us have exited those companies too. And we think that gives us a bit of an advantage in a couple of different ways. For example, we're pretty good at spotting the inflection point when we think companies are starting to really lift off and they should be on a pretty strong growth trajectory in the next sort of 6 to 12 months. We're pretty good at doing that. And then also because we have been on the other side of the table, we have run companies ourselves, startups, built startups, then we get on really well with the founders. So if we're in a competitive process to try and win a deal, then we're pretty good at winning those deals. But let's just dive into the background of myself quickly, initially, just to give you a feel for the type of experience that we've got on the team. So I have a background in academia, startups and startup acceleration. I've got a PhD in microchip design. I spent quite a few years in research in many, many different areas of research, published lots of academic papers. But then I started to help the University of Southampton to commercialise their research. I sat on their intellectual property panel for about 6 years, helped them commercialise, license, spin out, patent their ideas. And as I did that, I also founded my own company. So I founded and I've run 4 tech companies, had successful exits as well. When one of those companies exited, a company called Julo in the smart home energy space, I decided to help others do the same thing. So I founded a company, an accelerator called Future Worlds. And we helped over the course of about 4 years, about 55 companies to launch through that platform. And then I joined Blackfinch, and I had a great time building up Blackfinch Ventures, the team, the processes, and everything that you'll hear about today. And my experience is by no means unique on the team. So on the team, we also have Nick Pillow. He's one of my senior members of the team. He's also got a PhD, this time in computer vision. He's also an ex-founder. We've also got Richard Harley. He is also an ex-founder. He sold his company very successfully in the edtech space a couple of years ago, went into private equity and then joined us. So we've got a really good base of founder experience on the team, which I think really, really helps us. But let's talk about the products now. Let's talk about how it works. And I love showing this picture because it really illustrates quite nicely, I think, the story, the growth story that early stage tech companies go on. Now, this is obviously showing the story of a successful company because it's starting down at the bottom left there, and it's shooting up the screen towards the top right further on in its journey. But let's just talk through those stages. So all of these companies start down there at the bottom left of the screen, and it really starts with a group of people. It can be 1 founder, it could be 2, 3, 4, even 5 founders sometimes, who have an idea for a product or a service. They think that they can make something or a platform or a tangible thing that has value to someone and that people will pay for. And so they're down that very early stage of their journey. And what they often don't realize, but I spent a lot of time telling people when I ran my accelerator, was the only job they have, their single purpose in life at that point, is to test their hypothesis as quickly and as cheaply as possible, because it is inevitable, almost inevitable, that they will need to change shape, completely pivot sometimes, the product that they're developing. And so the ability to test the product and test it in a market and then pivot and change that as quickly and cheaply as possible is absolutely vital to moving through the stages in your startup as quickly as you can. So that whole phase down there, we call that the minimum viable product phase. It's sort of how it sounds. And normally they will be taking investment from angels and friends and family. So I used to do a lot of that when I ran my accelerator. At Blackfinch Ventures, we don't really invest in those companies at that earlier stage because most of those fail. There's a big attrition rate. And we like to focus on the next bit here. So this is the product market fit stage. And what this stage is very interesting because what's happened is that they've iterated and changed their product quite a few times by this point. They've got a minimum viable product now, and they're starting to see that when they go and try and sell it to customers, they're pushing on open doors. You know, they've got a value proposition which really strikes a chord with their customers. And you've probably seen it too, you know, when you go and you sell to your clients, you know, when you've got the right product and you're really solving a pain point for them, it's much easier to sell that product. And that's what happens in this little area of the kind of growth curve here. They start to go up that inflection point. And we're quite good, I think, at spotting that because of our experience, having done the same thing ourselves. Now, we do invest in that stage. We invest mostly through our EIS portfolios product. And it's quite an exciting place to be because some of those companies can grow very fast. And then they kind of move up this curve. And when you get onto this sort of steep curve here, so if this line is revenue, you might be talking about, you know, crossing a boundary of about $500,000 to $1 million revenue a year, that sort of stage. When they move into the steeper sort of curve towards the right side of the graph, we sort of refer to this as a growth stage, and they have different problems to solve at this stage. So they've kind of made the first good product by this point. And in the growth stage, what they're doing is they're trying to sort of operationalize and streamline their processes, their sales team, the operations, customer success, marketing, all of these different functions. They're historically, probably the founders have taken on a lot of that themselves. And getting that right is still quite difficult, but at least they've got a strong, solid proposition in the form of the product by that point. So at that point, that's our kind of sweet spot really for our venture capital trust. So we like to invest in companies where they've got strong evidence of product market fit, and they've shown some evidence of being able to scale, for example, the sales team quite effectively. But then we often co-invest between the two as well around this kind of dotted line here to be able to increase our check size and be more appealing to the startups. Now, I don't like to ever do one of these talks without talking about this little illustration here. There was a brilliant study done by McKinsey, who I'm sure you've all heard of, about a year and a half ago, where they looked at the 1,000 top most exciting, highest growth startup and scale-up companies in the whole of Europe. And what was absolutely fascinating about this study was that, incredibly, and you can see it here, 319 of those companies came from the UK, an incredible number, and more than double the next most impressive country, which was Germany at 149. And you have to ask yourself the question, why is that? And the reason why is simply because of the EIS and VCT opportunities in this country, because we often forget, because we're here already and we look at different providers, but the UK on the whole has an incredible opportunity to leverage private capital into these high growth, exciting companies. And that's why we're able to kind of push them through what's often referred to as the valley of death, the kind of funding gap, to the point where they can become those big growth scale companies. And that's very unique to the UK. So you've got a great opportunity in the UK to get the advantages of tax relief, which mitigate the risk, but also get exposure to these high growth potential companies. Now, of course, it is a more risky asset class. We know that. That's why the tax relief is there in the first place. But how do we mitigate that risk? And we do that by building a diversified portfolio. And we diversify the portfolio in two ways at Blackfinch Ventures. We diversify it over both sector and also stage. So sector is quite an obvious one. For example, if we had invested in only, say, high street retail technology, then the pandemic came along, all of high street retail sort of quietened off. That would have really impacted the whole portfolio of companies, wouldn't have been a good thing. But what we do is we invest across many, many different sectors. So probably between 15 and 20 different sectors now. And what that means is if you get a big existential thing come in, a big macroeconomic factor that we can't really control, then it might have a negative impact on, say, one or two out of your 10 or 15 companies. But it might even present an opportunity for a couple of your companies too, and it balances out that risk. And then the other thing we do is we diversify over stage as well. So if we go back to this lovely graph here, then what we do is we will make some investments which are a little bit further down this curve towards the bottom of the product market fit area. And those companies are, of course, higher risk, but you're getting in at a very low valuation. So if you get it right, if your conviction's right, then the kind of multiple that you'll get is really quite impressive on those companies. And then we'll invest in some companies that are further up this sort of growth curve here, where they're more established, the product is more established, the revenues are a bit more sort of steady, and so we have good feeling that that company's going to do well. But obviously the valuations are a bit higher. So we try and blend the portfolio to create a nice balanced risk across the portfolio for your clients. Now let's shoot through now the process that we use to both filter and look at and examine and due diligence those companies. And what I'll do, and you saw the title of the talk, it's about innovative ways to try and improve the return likelihood of these types of asset classes. What I'll do is I'll try and pull out the things that we do differently, that we think are a bit innovative, they're a bit unique, but do, we think, give us a bit of an edge. So let's start with where we get the deal flow from. So we get deal flow from all the usual places. We get it from universities, incubators, innovation hubs. We have links to many other investors, other VC firms in the UK, about 70, 80 of them. We share deal flow with them. We have our own networks. We have deal flow coming in through the website directly. We do marketing campaigns. We get it from all the usual places. But we do something that is slightly different, which is we use a research platform that most firms use to research the companies once they know they're going to invest into them. So it's a bit like going to LinkedIn and looking people up. We do that as well, but we also use this platform to search companies with very carefully crafted search terms that we think might be about to look for investment and we think could be really interesting high growth companies. And that often gives us, at any one time that we're looking for them, maybe 500, 700 companies. And we'll run that through our own algorithms then, and it's useful to have these kind of PhD backgrounds to try and order that list and prioritize the ones that, because of all the data we have on them, we think could be really, really good opportunities. And then we proactively go outbound to those companies. And that means that some of the companies that we look at, not all of them, but some of them are coming from quite a kind of unique, slightly exclusive deal flow source, which is that research tool. And then how do we filter those companies down? Because we probably see about 1,000 to 2,000 of those companies a year. Lots of companies cross our desks each year. And how do we do that? Well, one of the interesting things that when I entered the sort of the venture capital world and I saw, the way that everyone was doing this in the industry, and I had the luxury of designing our own sort of process from scratch, is that I saw that many firms, the way it works, if you're an entrepreneur, you'd go meet a fairly senior person, someone like myself, maybe for a coffee in London for an hour, have an initial chat, then maybe a couple more meetings. And it's probably quite likely that individual might then write up a paper on you to go to the investment committee, do the research. They'll probably lead the deal, the legal process of the deal. And they'll probably end up, even if it gets invested, they'll probably end up actually sitting on your board. And my problem with that process was that, you'll know that when you meet a client, then, your aim is to try and create good chemistry. And if you do have good chemistry, then you can get a deal done. And the problem is that if, as an investor, you just happen to really like an entrepreneur, it can really bias your decision making. And that's not something we want, because we want to make really strong, objective decisions about which of these companies to invest in. So we kind of turned that on its head a bit. And we said, look, every single deal that we get through the door, doesn't matter even if it comes from the CEO of Blackfinch, and this has happened, it will always go to my pipeline team. And these are more junior members, and they will experience that bias of first meeting the founder. And then they will also collect information quite objectively, quite clinically almost, under all of the kind of key headings that we look at. And then they bring that in a daily meeting to the rest of the team, to people like me. And we're then experiencing the company and everything to do with it, but from a very, very objective standpoint. And then we'll go back and we'll say, well, you should look at this, you should look at that. And we go around that loop until such a point where we're now happy to spend the time and bring them in and do a full bore pitch. And that's the next stage, is the pitch. And again, we've sort of designed this differently too, coming back to that kind of innovative theme of the tour. So when I ran my accelerator, I helped across those 55 companies, about 250 entrepreneurs. And when I was doing that, I got very, very good at taking really any entrepreneur, any founder, and coaching them to give a very compelling pitch. Might be a pitch to VC, might be a pitch on stage to angels, but we got very good at doing that. And we got very good at telling them how to also answer all the usual questions really well too, for about an hour, hour and a half. And so now that I'm on the other side of the table, I've been able to use that to my advantage, which is we run our pitches for quite a long period of time. So we run our pitches for about 3-4 hours. And really, we're trying to get out of the way that kind of 1.5 hour of very high gloss, high finish, very slick presentation that they've done a million times before that doesn't really tell us exactly what we want to hear. And it's really in the last hour, hour and a half, where we learn much more about the company, about the cracks, about the problems, At that point, their adrenaline's worn off a bit, and we're really getting to see what they're like. We're pushing them a bit, seeing if they're defensive, whether they're coachable. And so it achieves something really, really important, which is we're getting a very good view of what's really under the bonnet. And the other thing that it does is it gives an opportunity for the founder to really experience us. And as a team, I think they start to realize, we're ex-founders, we're quite smart, we've got a good technical understanding, and they start to sort of think, well, actually, I wouldn't mind having these Blackfinch, this Blackfinch team investing in my company. So it creates that relationship really well as well. So the pitch is a really important part of our process. And then what we do is we move on to an investment committee stage. And again, doing things slightly differently. What I always found quite difficult was the concept of taking a deal to the investment committee once you'd really invested, loads of time and energy, and you had to get that deal through because you didn't have anything to do instead. And to me, that felt a bit of a strange way of doing it, because we're certainly on our IC, we've got some really smart, clever people. We've got people that have co-founded enormous funds that you will have all heard of. We've got people that have added, loads of value to private equity portfolios. We've got some really smart, intelligent people. And I wanted to make sure that we were really getting as much value from their knowledge, from their mind share as possible. So what we do at Blackfinch Ventures is when we've got a short list of companies, and it will be more than we'll actually end up doing, then we take it to what we call an IC filtering stage. And we'll spend a whole day, we'll play them short 2-minute videos of the founders, we'll tell them, they'll get the 2-page short summaries we've written, the decks, the financial models, and we'll thrash it all around. And it's just a very useful stage where we're using, a bigger group of people to input into our selection. So, for example, we did this 2 weeks ago for the tax-year-end companies, the new companies we're looking at. We took 10 deals along, all of which the investment team would have been happy to do. And we thrashed them around, but knowing that we will only really go forward with about 4 probably. And so we went through that process, and what you end up having is maybe 1 or 2 fall away. You decide, actually, maybe we'll leave those ones. These are the ones we're going to prioritize. But it's a very good collaborative process. And then what happens is we'll work on the term sheets with those companies, which I'm doing right now, and we'll move to due diligence. We've obviously done a bit of due diligence already, but we'll go into the real deep due diligence. And we do all the usual things. So we do corporate DD, we do financial DD, we ring up their customers, we speak to customers that have left the company, that don't use them anymore. Why don't they use them anymore? We do founder reference calls. I actually speak to every single person in the company. That's one of the things we do to establish the culture of the company. We look at the competitors, we look at the market, we look at all these different areas. A couple of things we do with particular focus is tech DD. So we take a tech expert and we put them in the company for a day, and they look at everything from the high level architecture, the design of the product, all the way down to, if you're speaking to a developer, what are you writing today? What code are you writing? Show me your screen. How are you protecting the databases? What authentication do you use? All of these different details. So we're getting a really good view of what the technology is like. It's never perfect, but we want to know what we're getting into. And then the other thing that we do is we will always get a PI-backed tax opinion on whether this is truly an EIS or VCT qualifying company. They have advanced assurance from HMRC, of course, but we just wanted to be absolutely sure that it's definitely going to get those EIS and VCT reliefs. And then whilst we're going through that DD, we're actually running the legal process in parallel as well. And this is obviously working with our panel of lawyers to put in place the documents to make the investment, and also wrap a bunch of the kind of governance around the company investment. And what we do there is we do 3 things really, which we think are really important, that come in at that point to protect us and protect our clients and their shareholding in the company. The first one is we will always get a director seat on the board. And what we do, again, a bit differently, a bit more innovative, is we don't fill those director slots on the board with people from my team. We have an observer seat on the board, so we're still there, but we can't vote. What we do with the director seats is we have a big roster, a big network of venture partners, we call them, who are all very experienced individuals. Some of them have built companies, some of them are experts in their field, and we put one of those onto the board. And it's really good because it means it turns what feels a bit negative, we're going to have someone on the board, that turns it into a real positive for founders, and it adds lots of value. So they go on the board. The other thing that we do is, I think I sort of explained a bit, team is so important in these companies. You saw that graph at the beginning, the product will probably pivot and change. The team is absolutely vital. It's no good to us if we invest in these high growth, early stage companies, if after 6 months the team says, you know what, I've had enough, I'm going to go. So we incentivize the team to stay by what's called founder vesting. So they revest their shares. It means if they do leave within a period, then they'll have to hand some of those shares back. That kind of helps them stick through the difficult times, and there always are difficult times in these companies. But also if they do leave, it means we've then got a bunch of shares that we can then incentivize the replacement CEO or whoever it is that's left with. And that benefits everyone, because it means we've now got a good way forward, and not only our shareholders benefit that, but also the founder's shareholding who's left is going to be more likely they are going to return too. So we have founder vesting in there too. And then finally, we don't take majority stakes in companies. We can't do that anyway if we wanted to through the EIS and VCT rules. But what we do is we try and get a good level of governance by having what are called investor consents wrapped around the company. And this is a list of consents that mean that not for like day-to-day things, but for big decisions, the company, the executive team have to come to us for consent. So it's things like selling the company, for example. It's things like raising new capital, signing off a yearly budget, maybe even hiring someone that's really, really expensive, one of your kind of top C-level people. And they have to come back to us and have a bit of a chat. And it's a very useful process because we've got quite a lot of experience now in doing this, and we can try and advise them as well. So we have those three things that really help wrap a bunch of governance around the investment so that we can make sure that really good decisions are being made. So that's kind of brings us along the runway to actually closing and completing the deal. And it sounds like a huge amount of work, and of course it is. But the reality is the work has really only just begun, because now you've invested in the company, you've got to try and help and work with the company to make them a success, to help them make a success of it. And I think I referenced earlier this venture partner network, and that's an important component, an important ingredient in trying to help the companies become a success. And we have about 90 of them currently, but it kind of increases all the time. This network has grown rapidly over the last 4 years. And they have a very wide range of experience, but I'll talk about a couple now, just put a couple of those randomly out. So we've got Geraldine Osman. She is a founder. She co-founded a company called Staff Connect, took it over to the US, grew it there, exited to private equity. So she's been there, done it before. But really her superpower is in marketing. So she's very good at marketing, brand, placement, all those types of skills, which are so important when you try and get up that growth curve that we looked at in that earlier slide in particular. And so what we do is we put her onto the companies, 2 or 3 of our companies, where they really need a bit of help in that particular area. And she's been doing a really, really good job. Ashley Unit, again, just another of our 90 or so venture partners. Again, a founder. He founded a company called New Voice Media in the voice over IP space. So, when you started to stop using telephones and using computer systems instead, that was some of the pioneering technology. Very successful, exited that company in 2018. I think they sold it for about $350 million. He's been on the board of one of our companies for about 4 years now, 3-4 years now. Done a brilliant job of guiding them through a myriad of challenges. But this is just a flavour, really, just a flavour to show you the kind of thing that we do with the venture partners to try and add value. Now, this is normally the time where I launch into a description of some of our portfolio companies and why I think they're great and what they've achieved. But we're really lucky today because we've actually got 2 of our founders from 2 different companies in the portfolio that we thought we'd bring on the event so that you could all hear from them instead of hearing it from me. So the first person that I'd like to introduce is one of our founders that's called Leo Scott Smith. And Leo is founder, CEO of a company called Tended. So it's really great to have you on the call. Thanks, Leo, for joining the call.
Thanks, Reuben. It's really great to be here.
So what I thought we could start with, Leo, is perhaps you could just explain to begin with all about Tended. What does it do for its clients? What is the product?
Yeah, of course. So at Tended, we create wearable devices to help improve workplace safety in high-risk industries. So our clients include people like Rolls-Royce, Network Rail, Siemens, Babcock, and really they're using this product to help improve their workplace safety. So our flagship product is this wearable device that you can see here. And this combines the same technology that you would find in autonomous vehicles and drones to provide centimeter accurate positioning. So that's about 150 times more accurate than the GPS that you would find in your phone. And one of the primary applications of this technology is our work in the rail industry to improve situational awareness. So just to give you a bit of context around the challenge that this industry faces. So every year there's about 20 incidents where track engineers that are working out in the middle of the night, they'll lose situational awareness, and they'll have to jump out the way of an oncoming train with seconds to spare before they're struck by that oncoming train, unfortunately. And this has resulted in, over the past 22 years, about 37 fatalities in the UK. So with this wearable device, what we're able to do is link into Network Rail's planning system, and then it will automatically map out safe and unsafe tracks that these engineers can work on. And then the second that a track engineer strays out, even just by a few centimetres onto one of these unsafe zones that's potentially putting them in the way of an oncoming train, they're given an alert by this device and via audio and haptics to tell them that they're currently in a position of unsafety and they need to be aware and maybe take a step back from those surroundings.
So it's a brilliant product, and we've been really interested, fascinated to be part of the journey and support you over the years. I wonder whether you could tell us a bit more now about how the whole idea started. How did it begin? And then how you we talked about pivots earlier, how you sort of pivoted along to get to where you are today.
Yeah, no, of course. I think that we're kind of, as an organization, probably one of the pivot masters, because we went through the pandemic, which kind of really threw everything on its foot a little bit. So just to give you an idea about our journey, so it's been a really interesting one that Blackfinch has played a really crucial part in. So as a business, we've always had one sole mission, and that's to make a positive impact by improving safety. It's something I'm very, very passionate about. So it's really come from my previous experience. I used to work in disaster zones in developing countries with all kinds of life or death moments like earthquakes and ambushes. And I wanted to build a business and a product that could help to mitigate these safety challenges within workforces that are at very high risk. But getting there, kind of, as you mentioned, we've seen a few different product iterations and pivots in the business, because we originally began with a product that used AI to very reliably detect accidents and send for help for people that were often working alone. And this is kind of the stage where Blackfinch got involved. And we saw some great traction and success. So we had clients like Rolls-Royce and Nestle using the products, and we were beginning to scale this up. But then we were thrown into the pandemic, which brought a number of challenges. Many of our customers we were focusing on were kind of redirected to how they could bring their teams back to work safely. And this meant they didn't really have the bandwidth to be working on new, exciting products and innovations. So that meant that a lot of our contracts were delayed with kind of like an unknown point of when they would restart. So at this point, we had two options. We could either bunker down and weather the storm, or we could try and make a difference in such a challenging environment and situation, which, as I mentioned earlier, as we set out as a business, it was to improve safety. So we really wanted to make a difference. So we chose that latter option. And then between our customers, but also very heavily involved with Blackfinch and their isolation intern program that was ran, we used our existing technologies and ended up building a social distancing product. So this wearable device, it could very accurately detect the proximity between two individuals and then alert if they came within the 2 meter social distancing limit, as well as them providing some really accurate contact tracing behind the scenes. So in about 6 months, we built a whole new product supply chain. We ended up delivering about 8,000 devices. We grew to £800,000 in annual recurring revenue. And it was a really exciting time for us. But fortunately, for everybody, the pandemic wasn't something that was long term. So at this point, we kind of had a junction and a decision to make of where we went next. Did we return back to our previous product, or now that we had a few years under our belt of working with so many industries, were there better opportunities? And one of the big industries that we worked with in this during the pandemic was Network Rail and many of their principal contractors. And this is when they kind of shared these challenges they're facing around so many fatalities and really serious incidents. It was just after the Margam incident in 2019, where two track workers were unfortunately struck by a train. And they said, look, we really need to find a solution to this. And then the regulatory body of rail then put an enforcement notice saying they had to implement something. So we then worked really closely with Network Rail, and that started in 2020 to get to the point where we are now. And I think that we're really at this very exciting inflection point where we've got a product that very recently Network Rail stated would have prevented about 70% of the track worker fatalities that they've seen over the past 22 years. So it's been an interesting journey, but we're now really at this very strong point of inflection.
Yeah, and it really has been fascinating, and just seeing the product today, and my own background being in this kind of area, hardware, and dealing with big companies and enterprises like that, I'm very excited to see where you've got to. But perhaps you can give us a glimpse now, just looking ahead to just sort of 12, 18 months, because I think it's going to be such an interesting time, without going into any confidential information or anything, but just give us a glimpse over what we might expect to see over that sort of time scale.
Yes, of course. So one of the things with bringing safety critical products to market is that they are often very sort of driven by regulation, which means that it can be quite a challenging environment to try and break these new innovations into the market, no matter how much of a positive difference they'll make. But because we've started this in 2020 and we had this drive from the regulatory body, we're now in a position where we've just got what's referred to as product approval in the rail industry. So this is a kind of almost globally recognized sort of standard to say this product is something that can be implemented in a safety critical manner to help prevent serious accidents within the industry. And what we've seen off the back of this is that we got that approval in October. Network Rail then created a standard to basically get close to almost mandating this technology. And we're now seeing not just Network Rail looking and deploying across many of their different routes, but also all of their principal contractors and also international organizations as well, saying, hang on, if Network Rail are doing that, we should be doing that. So rather than us having this point of of having to break the door down, we're now having people trying to break the door down of us to say, look, we want to get our hands on your technology. So the next 18 months are really about driving into the rail industry, becoming an industry standard piece of equipment. But as well as this, a lot of different industries take sort of recognize what Network Rail do and try and duplicate that. So we're just about to start something with National Grid, as well as also national highways, so looking at utilities and the highway sector. And we're also just about to break into 3 new countries, which is the Netherlands, Canada, and then also Germany as well. So it's really about expanding into new markets and also expanding into new territories as well. And this is kind of all happening over the next 12 months. So it's really, really busy, but a very exciting time to not just grow the business, but also to make such a positive impact to so many people's lives.
I was going to say, it's so good that all of this is great on the commercial front, but it's also doing such a great job, isn't it, for people around the world that need to be kept safe in their jobs. So maybe just casting your mind briefly a little bit further ahead, 5 years' time, where do you think, I know you're a very ambitious company, really strong values, where do you think Tended is going to be in 5 years' time?
So 5 years is an interesting one. I think that so as a business, we're only 5 years old today. So to look at what we've achieved in 5 years and what we're going to sort of look ahead to achieve in 5 years is a really exciting time. As you say, I'm super ambitious. I think for us, there's 2 ways to look at this. I think that as aspirations for Tended and our team it's ultimately at that core roots of making a difference and improving people's safety. So we have a way, it's quite hard to measure, but have a way of measuring how many lives we've actually been able to save. So we're really focused on growing that number as high as possible so that in 5 years we can say, we've prevented 100 people not being able to return home to their loved ones, and really making that difference and changing the world. I know that that's that aspirational thing that so many people will say, but I think that's a core thing, and that's looking at expanding into these markets and territories and really getting a product that is industry standard, where nearly everybody is going out and wearing one of our devices to make sure that their safety is monitored. But I think that there's another way to look at this as well, which is that over the next 5 years, I think it's going to be very interesting from a perspective of shareholders and Tended as well, because as we're moving through this inflection point really quickly, we're starting to get a lot of interest from a number of very large and well-known organizations on who have synergies within our industry, and they're wanting to kind of add new products into their portfolio to become more strategic and break into new markets that we've been sort of so successful in doing. So these companies that are reaching out, we're kind of evaluating, do their values fit? Is it enough to make us grow to where we need to be? So, you know, on the agenda for those next 5 years, I think that it will probably be finding that right partner that will help us to achieve our mission and our goals. And then also, it would be obviously great for our shareholders to see, you know, a great return who have all backed us over so many years.
Well, Leo, thanks so much for joining, and we'll be watching with great interest as to see what happens next, and obviously continue to support you. But thanks for joining the event. Really appreciate it.
Always, thanks.
So that was Tended, and Tended is a really good example, I think, of one of those companies that was really early stage actually when we first invested, and we had a lot of conviction in Leo and his team, and we've backed him ever since. And now we're seeing this really, really strong inflection in the company. But what we'll go to next is we'll go to a different company, a company called Edozo, and we've got the founder of this company, Marcus Ginn, who is the founder and CEO of Edozo, with us as well. And I just thought it'd be really interesting to have a chat with Marcus as well. So Marcus, welcome to the event. Great to have you on.
Hi, Reuben. Good to be here. Thank you.
So Marcus, again, Edozo is a fascinating company, and it's disrupting an industry through the use of technology, but it's a different industry this time. So it's sort of commercial property. Do you want to just a bit like Leo did, tell us about Edozo, what it does, and the value it brings to its clients?
Sure. Yeah. Look, we work with the commercial real estate sector, which everyone knows is very valuable as an asset class, about £1 trillion in the UK alone. Anyone that works within commercial real estate will know that it hasn't changed much in how it's operated for several years. That includes the processes used and the software that supports it. So it still takes weeks to value commercial real estate, months to transact. And we've built a software platform to make commercial property research, valuation, and ultimately transaction far more efficient and more accurate in many senses too.
That's really, really good. And we invested in the company a few years ago. I think we've invested through both our EIS and our VCT, and we've sort of supported you over that time as best we possibly could. But one of the things I found really interesting is how you stay very close to your customers and how you've used that knowledge and that understanding of what they need to develop out your product and the different parts of your product. Perhaps you could explain a bit about that.
Sure. Yeah, I think it helps that my co-founder Andrew and I both came from the commercial real estate sector. So I built quite a big service business in the sector, and Andrew was a valuer and agent for nearly 20 years, working with some of the big consultancies. So we understood the problem ourselves. And then whilst building our the first app on our platform, we worked closely with our initial clients, big brands like Allsop and JLL. And as we've evolved the platform over the last couple of years, so we've gone from 1 to 3 apps on the platform in the last 2 years. Again, we've done that with key clients who've had input in product design. So we know we're solving real problems for real customers as we expand.
Yeah, and I know that what we've seen along the way as well is looking closely at competitors. And that's always a worry, isn't it, for any startup, is trying to make sure you stay ahead. And perhaps you could tell us a bit about how you do try and keep your edge and stay ahead of your competitors, because it's been some fascinating stories over the years.
Yeah, the competitive dynamic was one of the reasons I was so keen to start Edozo. So just as the processes used by commercial real estate professionals hadn't changed much for decades, so they were using the same technology stack, the same limited range of software providers that they'd had for decades. And when you sat down and spoke to them, they said, of course, we want something new, more efficient, better designed, and better priced if it can be made available. So that was the backdrop. And then we've tried to move just so much faster than the big corporate multi-billion-dollar businesses that we compete against, who've taken on a kind of monopolistic tone over the years. They tend to have dominated the lane in which they've sat and not been as agile as us. And now, as we're making real progress, we're not just winning customers from those big competitors, we're also winning team members who are joining us from those legacy tech companies because they want to work with the new, better solutions available in the market.
It's always good when your competitors' employers want to come and work for you, isn't it? It's a bit of a good sign. So great to hear about that. We talked about venture partners earlier on. And you've obviously had a director on your board for a while. You've had observers, a few of us being observers. Do you just want to kind of explain whether that's been helpful or what your experience has been of that from your perspective?
Yeah, look, that's been great. When we took investment from you guys, we had a board, but it was certainly greatly strengthened by having a Blackfinch observer, initially you, Reuben, and then one of your team sit on the board. And also you brought, of course, a venture partner in as a statutory director. That was a positive experience because you worked with us, I remember clearly, to really identify what we needed to add to the strength of the senior team. And we discussed the fact that we needed a proven experience of scaling a technology proposition from a go-to-market perspective. So you identified for us a really strong non-exec director with that experience of sales and marketing in the technology space. So it's been very valuable because when you're building a business, working hard with your team, you do need on a regular basis to be challenged and to have some different thinking to make sure that you're on track. And that's certainly been the case.
I remember lots of interesting discussions in the early days when I was the observer on the board. So, when we talk about property technology companies, people sometimes get a bit worried in a downturn because they automatically assume it's related to sort of property sales or the like. But at Edozo, in a way, you've got quite a unique position because you can sort of almost benefit, can't you? There's almost a bit of a boom for you when these sort of interesting times come. Do you want to explain how that works?
Yeah, our central proposition is we make it faster and more accurate to value commercial property. And we're most valuable to the sector in a dynamic period, that is price dynamic. So this is clearly one of those price dynamic periods. One of the big challenges in the sector now is working out what real estate assets are worth, because they may not be worth what you thought they were 12 weeks ago. So our data is more valuable. The platform is more valuable. And also we're providing time and cost saving solutions to our customers. So we think that this next 12, 24 months with a more dynamic commercial real estate sector is actually a really good period of opportunity for Edozo to add value to the sector.
Thanks. I'm going to throw in a new question here. So you've been doing this for a few years now. You're a very smart guy, but I'm sure there's been a lot of learnings. And perhaps you could kind of reflect on, if you could go back to when you began and you could tell yourself, something, one or two things, a bit of advice that you think you could have really benefited from way back then, what do you think it would be?
I think everyone knows that having the right team is vital, but I think everyone still probably underestimates how vital it is. So having the right people involved at every step in the journey, even if that means making some hard decisions about reallocating resource or even exiting people from the business. I think that's something that you've got to be really disciplined at if you want to scale a business and not be held back by having a perfectly adequate team in some respects. And I think the other point is everyone thinks they're building product iteratively and listening to their customers. But again, I think looking back on it, that's something that you can always do better. Are you really being customer led in the product you bring to market, or have you developed a pet project? It's important that it's the former, not the latter.
Yeah, and on the team point, there's a great book called The Hard Thing About Hard Things. I can't remember if you read it, but that's a really good one, isn't it? It's a tough journey going through that process. But back to that horizon scanning. So Edozo is a company that we've seen, certainly since the pandemic, has had such strong, consistent growth, year-on-year growth. And it does sort of feel like now you have these three kind of core products really well fleshed out. You're really understanding your customers, that you are poised for quite exciting things in the next year or two. Can you just sort of reflect for a moment and tell us what you think, where you think Edozo is going to be? What do you think is going to happen over the next kind of 2 or 3 years?
Sure. So look, as you say, we've expanded the number of products or apps on our platform threefold in the last 18 months. So commercially, we're in a great position to cross-sell and grow our average customer value. But at the same time, and this is more exciting really, to add more value to our customers. We're intent on becoming an essential tool for the commercial real estate sector. We are the only platform that combines our particular range of digital mapping, unique property data, and automation tools. And we want the majority of commercial real estate advisory firms valuing and trading commercial real estate to be using our platform over the next few years. We'll also then move into adjacent verticals. So whilst we're focused on valuers and agents today, we know that we can be selling to investors and lenders tomorrow.
I think it's a very realistic ambition. So Marcus, thanks so much again for your time today. I know you're super busy. Great to have you on and just to hear a few words. So thank you very much, Marcus, for jumping on.
Thank you. Great to see you. Thanks, Reuben.
Bye for now. So, and we can't really chat about existing portfolio companies without talking about one of those companies, which was our first exit, which was a company called Candidate ID. And this company exited about a year ago. Blackfinch Ventures has been going for about 3.5, 4 years now. So it's really good to see that some of the processes and some of the things that you saw earlier on are starting to sort of come through, and we're actually getting the exits that we're looking for. So Candidate ID was a company in the HR sort of recruitment tech space. And what they did is best illustrated through an example for one of their clients, which was Specsavers. Specsavers really struggled to hire really top grade optometrists. But what they realized was that actually they have thousands of them that had applied for jobs in the past. And what Candidate ID's technology did was it helped them to automatically, without really any involvement, nurture the thousands of optometrist applicants that they'd had in the past. Continually, just sort of touch points, little emails here and there. And in doing this, it meant that when Specsavers wanted to hire a new optometrist, they could just go to what was called the hire ready list that was provided by Candidate ID to identify those they could go straight away to, and it'd be very likely they'd be interested in the job. Really good company. And what happened was a big company called iSIMS came along a couple of times actually, but in the latest time, about a year ago, really interested to sort of buy that company, got a really good multiple for it. And we can't talk about the actual sort of absolute numbers. What we can tell you is that some of our clients that had invested in that company that we'd invested in as part of their portfolios got 120% IRR, which is their sort of effective equivalent yearly return. So a really good one to talk about there. And before I hand back to Wayne, who will sort of take back over, I wanted to just talk through one other thing, which was around how this is a very unique time in the year for us because tax year end is coming up. And again, coming back to that kind of innovative approach type of thing, one of the things that we're really well known for is being able to put together very highly diversified, high quality portfolios for clients, even very, very close up to tax year end. And there's a reason that we're able to do that. We're able to do that because we've built some technology. We built an algorithm that basically takes any number of potential companies that we want to invest into. So we have lots of companies over here, and then we take any number of clients. So it's all of our existing clients that we haven't maybe fully deployed, new clients, some of your clients around the call, and we're able to sort of press a button and figure out the most optimal combination of dealing those clients into all those companies to give them all the best possible portfolio. And that happens almost instantly. So this would normally take a firm, I mean, it used to take us before we built this tool, maybe 2 weeks just to do the process of figuring out how much to put in each company, all clients, and then going through all the different processes internally. But this tool allows us to do it almost instantly. And what that means is that we can stay open really late towards tax year end. Your clients could be deploying capital into Blackfinch Ventures, particularly the EIS Portfolios product. And just days before tax year end, it could be fully deployed into one of these high quality, well diversified portfolios before tax year end comes. So it's a great opportunity, absolutely brilliant opportunity for carry back tax allowances clients with that. But now let's go back to Wayne, and that's the end of my little session.
Excellent. Thank you, Reuben. Thank you, gents. That was really insightful. I am pleased to say that we've had some questions come in. And Reuben, actually, a couple of them are probably best for you. The first one relates to what you were just talking about, really. How many companies do you think we'll get if we invest now for tax year end? Someone has asked. Yeah,
that's a great question. So in our brochures, you'll see that we always aim to invest our clients into at least 10 companies within 12 months. At tax year end, we do it really, really quickly, as I was just explaining. So it would actually be potentially in a matter of weeks or days. I think, and there's no guarantees, of course, with any of these things, but I think rather than 10, it's going to be more like around sort of 15 companies this year. So a really good diversified portfolio for clients.
Excellent. Another one is, have you changed your investment thesis in light of the current economic climate?
Yeah, no, that's a good one too. And I guess we're constantly looking at what's going on around the world. We're constantly sort of evolving our thesis of investment to try and adapt and make sure that the investments we make have the best chance of, a return and balancing risk with that. And I guess what we're focusing on at the moment, so I said we've been looking at these companies for tax year end. We're really focusing on companies that are very good at managing their cash. So we might invest £1 million into a company, but we want to know that's going to go, and execute a really good growth strategy. But if it doesn't go quite right, things don't always go right in startups, of course. If there's a big macro event that comes in, and we've had lots of those over the last 2 years, we know those companies are very good at managing cash. We know they've got evidence they've done it before. And so they'll be able to stay on top of that, ride it out, or develop their way out of that problem, and we'll be there to sort of continue to support them. So it's really looking for very capital efficient companies with solid fundamentals, good potential for good growth, but able to manage their cash really well.
Excellent. Last one, we've probably got time for one more. Can you give a specific example of how you've added value beyond the capital to one of your companies?
Yeah, absolutely. Actually, I can give you two. So one of them is really quite pertinent, because in a way, it's probably the biggest value we can add. And that is with Candidate.IT, the company that acquired them actually approached them a year before. And they said, hey, really interested in your company, we'd like to buy it, would make you an offer of X. And the founders were quite keen. They thought, oh, cool, it's a good amount of money. Maybe this is a good thing for us. And they came to talk to us about it. And I spent many nights, talking to them and quite kind of neutrally in a way, and sort of saying, well, let's just look at this and look at how the scenarios work out and do some spreadsheets. And I kind of ended up making them see that actually, if they held off, then I was convinced that they would get a much better deal, even just 10, 12, months down the line. And I spent a lot of time with them doing that. And in the end, they totally got it, and they waited. And then a year later or so, the same company came back, and sure enough, they got, a much better deal. And so that was a really good example of how we got good, better returns for our clients and also the founders. And then another example was a company called Spotless Water, who make ultra pure filtered water that window cleaners use. So when they clean your window with a brush and you see the two little jets of water, that's ultra pure filtered water, probably from a Spotless Water station. And when we invested in that company, we were really adamant that they needed to bring on sort of data scientists, people that could really understand where you would put these dispense stations around the UK to get the best yield. And they did that. We helped them find some interns to bring on that had data science experience. And that really helped them to increase the yield of those stations around the country.
Excellent. Thank you for that, Reuben. Right. If you've asked any questions that we haven't answered, then we will attempt to come back to you as soon as possible with responses, assuming we've got your name, that is. But for the last couple of minutes, I'm just going to mention what we're offering in terms of our EIS and VCT. So, as Reuben said, the Blackfinch Ventures EIS aims to deploy capital across a minimum of 10 companies over a 12-month period. So we target 3 to 5 times the capital invested, with a target exit period of 4 to 7 years. Obviously, there's no guarantees to exit timescales, but we do only take our annual management charge for the first 4 years. So we are incentivized to seek exits. Exits are typically going to come in the form of trade sales or potentially IPOs. It's just a 10,000 minimum, and we actually have quite a high bar. Our hurdle rate for the performance fee is 130%. So our performance fee of 20% kicks in on gains above £1.30, and that's on an individual company basis. You can, obviously, if you agree advice fees with your clients, we can facilitate those. And as Reuben alluded to, really pleased to say we can take investments for full deployment this tax year up to the 24th of March at 3 p.m. So you've got an opportunity there for investments this year, and obviously carry back. It will be available to the last tax year. In terms of the VCT, we are targeting 5% dividends from early 24, but there is the potential for special dividends from early exits, any above target exits between now and then. Minimum is just £3,000 on the VCT, and as with the EIS, we can facilitate advice fees both upfront and ongoing. Like the EIS, the performance fee applies to returns on a share price of £1.30 and above. So again, that's quite a high hurdle relative to other VC schemes. And if you consider that our current VCT share price is 90.85 pence, there is significant headroom for growth before we start to earn our performance fees, relative perhaps to more mature VCTs in the market. Existing Blackfinch investors, doesn't matter which service they're in, always get a 1% discount on the VCT initial, but also investors between now and the 3rd of April will also get a 1% discount of our standard initial fee. And I'm pleased to say there are actually 3 more share allotments before tax year end. Now, we really like advisors to try us, if you like, try before you buy, but as an incentive or as a thank you, we do waive our initial fee for your own investments. If you are investing yourself or you're thinking about it, please do get in touch, and we can obviously provide information and illustrations. We also now have applications online if you want to do it that way for both EIS and VCT. So we are that much easier to deal with now, not just sort of traditional paper applications, but we can still do that, of course. Last but not least, a few additional resources. Your BDM at Blackfinch is on hand to discuss planning opportunities with you. We have a number of guides also, though, to help you with both things like VCTs or ESG within tax-efficient investments. Lots of case studies and insights. Also some guides on things like EIS loss relief, business relief, areas that legislation, if you like, that can seem complex. So please do let us know if you're interested in any of the resources. The white paper that's mentioned on screen has been really popular, and it really plays into that story you've heard from Reuben and the founders about the importance and success of UK SMEs. So hopefully we've covered the learning objectives, but we really do value your feedback. So if you can answer these questions that you'll see on screen, hopefully, there we go, then if you can take a minute just to answer the questions, we will then send your CPD certificates across, hopefully by the end of the week, within the next day. But that's it for the webinar. Thank you so much for your time today and listening to us. If you have any questions or you want to know anything more about what you've heard, please do get in touch with your local BDM, or you can always email enquiries@blackfinch.com. So all that remains is to thank you for attending today's webinar, and we look forward to speaking with you again very soon. Thank you and goodbye.